So that's the first two trades that we had. So the next one is called the Volatility Rise. Okay, so going into earnings, and we explained this somewhat in the pre-runners, where we're guessing direction based off of historical patterns. Here, we're not guessing direction. We're just guessing that the volatility is going to go up and that it's going to move enough for us to hit a profit. So we look at two different trades for this, a long straddle and a long strangle. Normally, I'd never trade these except for what would be this trade. This trade and the mover trade. So if you're buying two options, and I guess the best way to show that is we'll skip down here in case you don't understand. So this is an example of a straddle. So the current close is right here, and you're buying a call above and then you're buying a put below. So the volatility, you can see obviously it costs you, I think this is a high price stock, it costs you $2,415 to get into this trade. Obviously I think this, I forget what trade this is, stamps.com. Okay, so pretty high price. So you're buying basically like a one standard deviation away. And the system will tell you which strikes those are. So you're just buying a call and a put here, and you can see there wasn't much drop here. If it gets a little choppy, but as soon as it moves, the profit's going to go up. And if it moves enough prior to that earnings, you can get out for your 20. We're looking for a 25% here. So that's the strangle. The straddle, you're just buying right at the current close. So if the close was 209, you're just buying the 210 strike. So this one will move a little more. Obviously costs a lot more, which is why we prefer the long strangle over the long straddle. And if you have questions about those strategies, we can obviously go into those individually, and we cover them at our weekly meetings too. So same thing, we're looking 20 days in for 25% profit. We do put a stop loss on this, 50%, and we go in, you close it when the target's met, the stop loss is met, or right before the earnings release. So like I said, strangles are the primary, but I tested for strangles and straddles in that data set, so you can, it's a big sheet there. So you can see which one. You'll see that the strangle does better most part. So it costs less and usually outperforms the straddle, which is why we buys to it. But we do test for the straddle, and if that outperforms, then we'll select that as the best trade. So you're getting the vol rise, so that's going to minimize your time decay on those two long options, the long call and the long put. Normally when you buy one of these, it's got to move right away, which is why I pretty much never do like a straddle or strangle unless it's for this kind of specific earnings type trade, because you're getting hit with double time decay. So it's really got to move, and it's got to move in a short time window. So we do have a short time window, and to counter any of that time decay, we buy out a couple months, so that'll help minimize the time decay. And then we have the volatility rise. As long as we find the proper candidates that are having a good volatility rise, then that'll counteract most of, or if not all of that time decay that we see. So with that, we have that offsetting time decay and volatility rise. So when the stock moves, it's gonna, if it moves enough prior to that earnings, either up or down, then we can get out of that trade. So the thing I like about this trade a lot is, you don't see much of price, drops going into that earnings amount because of the volatility rise. So, unless it's like dead flat or just like, up $1, down $1, up one, down, that unless you see that, I mean, even that, you're not going to see much of a loss on this. So, so you're just kind of biting, waiting your time before that earnings, and just hopefully, it moves one way or the other enough that you can get out. But your downside is fairly minimal on these. So the strategy, so the straddle, we went from 20 all the way down, I think I did like 3 days on this. So we're looking for a 25% profit target, and we have a 50% stop loss and 60 days to expiration. So we're buying a 48 delta, so that would be slightly above the current price. And if there's no 48, then it'll look for a 49, 50, 51. So it'll be right around whatever that current close is, depending on what the strike width is and the price of the stock is, and there's lots of factors with that. But the system will tell you what strike and expiration that you should buy. And the strangle, so same thing, 20 days, 25%. And instead of that, because you're buying two here, we're looking at the upper and lower standard deviation. And those are calculated in our system. And I'll just kind of show you real quick here. Someone kick me out. So if we look up an options chain for, let's just say Apple. So if any of the expirations available, so if I have to say 1016, it'll tell you the standard deviation range in that table for that expiration. So if you go out, to November, it's going to be a different range. So basically, it's just picking that. So it's buying the put right above 93.85, and it's not showing here. So 93.85, the next strike would be so you'd buy a 95 put for this one, and then you'd on the call side you'd buy the 140 call. Whereas on the straddle 150, you would basically be buying that 115 call and put. So that's the difference on those. And I think that's it on that. How to find good candidates. So we're screening, we want the at the money implied volatility here to increase at least 15%, from 10 days out. So within the 10 days prior to earnings, the at the money volatility is going up 15%, 7 out of 10 years. And you can modify these, obviously, to whatever criteria you want. That's what we found to be a pretty good parameters. So you can see here, stamps.com, and this is 20 days out, which reminds me real quick before we dive into this. So under the earnings, so I showed you the calendar. There's also an analysis tab. So you pick stamps.com. So this is like the individual analysis you can do on each symbol in the system. So there's corresponding tabs for the types of trades that we have. So like this is the earnings move, what was expected and what actually occurred. So, and then, you know, the pre-runners, you can see in here, okay, 15 looks pretty good. And then volatility rise. So all of these have explanations up here in case you don't know exactly what you're looking at. But here's that, you know, stamps 10-day at the money. So you can see you're getting really good vol rise with stamps.com at the money there. So also, like we have vol crush and then a runner tab too. So, you know, if you have a system, you can go in and analyze any of these stocks individually. Okay. So we can see this is a very good candidate for the volatility rise. And then, you know, we go through and test it. So at 20 trading days prior to earnings, so that's when you enter in that long straddle, which will be, you know, buying the call at the upper standard deviation and buying the put at the lower. Now, here's your risk amount. You know, you can see these are a little longer trades than like the bullish pre-runners, but you know, obviously you had 100% win rate on these. No downside on these. So pretty good trade overall for stamps. And this is just a comparison so you guys can see the difference between the straddle and the strangle for stamps, and it's both at 20 days. So the cost of the straddle, which is the at the money call and put, was $8,130, and this was for the last quarter where we entered on July 9th and we got out on July 29th. So it cost us $8,000 to get into that, and then, you know, when we closed it out on the 29th, you know, we had a, you know, $1,325 profit, which was 16% of what, you know, it cost. So the strangle cost us a lot less, you know, $2,400. You know, our profit was a little smaller, but compared to how much we risked, you know, significantly better result. You know, 44% off of the money we put in this one, whereas that one was 16. And this is just the virtual portfolio where we can, and Shawn's going to go into this a little more, but, you know, we can, we always say, you know, when we have a strategy that, you know, we think is going to be profitable, you know, we test it and then we trade it virtually first. So these are our virtual portfolio where we can go in and enter into trades to see how well they perform live versus, you know, just going off of a back test and saying, okay, it looks good on a back test. You know, let's actually, you know, trade this, you know, kind of paper trade this first and then, you know, get more comfortable. And then once we're comfortable, then you can actually put real money to work. So this is the strangle, and you can see, you know, obviously you had that big spike up on the 29th, and that's where, you know, your profit was hit there. And you know, this is the straddle, so you can see profits amount, and you know, you made more money slightly, but you know, you had to risk a lot more. But you can see the downside on these isn't very much. You know, it just has little dips. And the same with here, you know, not significant drop downs here, which is why I really like this trade. So another one, Disney. So the 10-day IV rise, you know, obviously looking real strong here. You know, we're to screen in for like 15% or so, and this is doing really well going into the earnings there. So this one is, you know, you enter 4 days prior to the earnings with the straddle. You know, you had one loss there, 90% win rate, overall strong. Obviously a lot shorter trades. So, you know, I mean, my ideal trades are shorter and, you know, good profit and short, you know, the shorter the better. So as long as it tests well and, you know, it holds up through like virtual trading, then, you know, I say, you know, start putting real money on it. But, you know, try and get as high as profit in the short amount of time as possible. I mean, that's the goal, right? So overall, very strong profit factor here. You know, minimal downs. You know, you had some nice winners. You know, you're not gonna you know, buy a new house with this, but obviously, you know, as you do more and more of these trades, these things add up, and you know, you make good money each quarter. So you can just kind of increase risk amount, and you know, it just kind of compounds. So this one, we had 33 over 80%. We have 90%. We have 9, and then we have 2 that were 100%. You know, same thing with the, always, you know, especially nowadays, verify that the earnings date with a secondary source, just to be sure before you get in that trade. We covered that with all those. So this one, you can also put, you know, we have a 50% stop on these. So, so you can put that order in too if you want. A lot of people don't do that. They just put in the profit and they kind of watch it. Normally, you know, you shouldn't be hitting that stop anyway. And always make sure you get out prior to earnings release on these. So we'll just kind of look at this one real quick. So here's the raw data. So this one's a little more complex because I went through and did strangle raw data. So that's all the symbols, and then the straddle over, strangle over 80, and then I did strangle best trade. And then I took the straddles. So then I ran straddle for all those, did 80%. And then I went in and put them side by side so you can see, you know, the best straddle trade for a line versus the best strangle trade for a line. So, you know, obviously, this, you know, the strangles are more prevalent. You know, I kind of default to them because it's less risk amount. So, you know, feel free. You know, you can download this. You know, you can't edit anything in these, so you can, but you can download them and, you know, alter them as you want to. But, you know, if I was looking at these 2 trades, obviously you made a little more money on the straddle, but if I go into the system and you know, see how much I was risking for this amount versus this amount, I guarantee that that strangle is going to be a better trade. Okay, so that's the volatility rise, and I'll open up to questions on that. I'm going through the chat right now. Looks like Shawn's on this pretty good. Yeah, so it is similar. This volatility rise is similar to the pre-runners, but this is non-directional. So, you know, for the bullish pre-runner, you got to get direction right. For this one, you know, you just need it to move. So it's kind of a different goal. If it goes up, great. If it goes down a lot, great. Either way, you're winning on this volatility rise. If it goes kind of flat, then that's where you get into problems, or it's just kind of choppy, or, you know, the volatility rise doesn't actually occur. The pre-runners, the bullish and bearish, you got to get the direction right. It has to move in your direction. So, so that's the big difference between these. But they do have similar, other than like how you're trading them, they are somewhat similar. Okay. Any questions so far? Any other ones?